Hi everyone, welcome back. We have covered till question number 30 today. We will be continuing with question number 31 onwards, and there are only four questions left in this reading. So let's get started and try to complete it as fast as soon as possible, so that we can move to our advanced questions on valuations. And after that, we actually also have to prepare a live model of a company. So we will be able to start that only once we wrap up this portion. So let's get started. So question number 21, if you look at the question number 21, so the scenario here given in the question is that you are comparing two vending machine businesses that are identical in every way. So same revenue, same cash flows, etc. The only difference here is how they pay for their vending machine prices. So business A owns the machine, records the depreciation each year, and business B leases the machine, records lease expense each year. So here you are told that the dollar amount of the depreciation and the lease payments are the same, and everything else is held as a constant. So because one is expensing it out and another one is depreciating it. So the accounting difference comes in case of expense type, location on the income statement, and effect on EBITDA here. So the accounting difference, because the accounting difference, which is created by expense type, one will be depreciated and another will be expensed. So depreciation is a non-cash expense, which will later on be added back to the cash flow statement. And the another business where they are leasing the expense, so it will reduce from selling general administration. And in the income statement, the location will be below EBITDA for business A, and for business B, it will be above EBITDA. If you are buying a vending machine business, would you pay a higher multiple for a business where you own the machine and they depreciate normally, or one in which you lease the machine? The cost of depreciation and leases are the same dollar amounts, and everything else is held constant. And you would pay more for the one where you lease the machines. Enterprise value would be same for both machines, but the depreciated situation changes charges. The depreciation situation, the charge is not reflected in the EBITDA, so EBITDA is higher, and the enterprise value to EBITDA multiple is lower. As a result, for this lease situation, the lease would show up in SG&A, and it would be reflected in EBITDA, making EBITDA lower and the enterprise value multiple higher. So this here in this question, they have given us the treatment of how, if we are depreciating something, so how it will increase our EBITDA. So EBITDA will be inflated, and if we expense it out, if we in the lease situation, the lease would show up in the SG&A, and it would be reflected in EBITDA, making EBITDA lower and the enterprise value multiple higher. So if the denominator will be reduced, so it will give us a higher multiple. So just simple as that. So this will, so that's why we will give preference to the one which is leasing the machine. I hope by now you are able to figure it out on your own. This was not that much difficult, but it actually demands you to your knowledge of the income statement and the three financial statements. Your attention in the three financial statements, your understanding of the three financial statements will be tested here. And this is just a simple ratio. The enterprise value will be same in both of the questions, but EBITDA number will be higher in the case where they have capitalized it, and EBITDA numbers will be lower in the case where they have expensed it out. I hope this was clear. Let's move to question number 32. The question number 32 is how do you value a private company? And this is a common interview question in investment banking, corporate finance, and valuation roles. The goal is to see if you understand the valuation methodologies used in valuation methods used in finance, how to adjust them when dealing with a private company, because private company shares are not traded publicly and the data might not be up to date. The key idea here, uh, you generally use the same core financial valuation methods for private companies also, just as just same as the you use for the public ones. So the three methods were public company comparables, which was trading comps, precedent transaction analysis, which was transaction comps, and discounted cash flow analysis, which was DCF. But since private companies do not publicly trade, there are important adjustments and limitations. And the what the private companies lack is discount for lack of liquidity. So public companies have liquid shares, and investors can buy or sell them easily, but private company shares cannot be easily sold or traded. And therefore, the value of the private company should be lower, even if it's identical to even if its financial performance is identical. And analysts apply a liquidity discount to those companies, often at around at a 20 to 15%, to reflect this lack of liquidity because they are not very liquid in nature. So if you buy a share or if you buy stocks of a company on the stock market and you want to sell them, you can sell them immediately, and that's what the liquidity is talking about. But if you are having shares of a private company and which are not listed, then you will actually have to hold on to those shares unless until you get somebody who will take those shares off from your hands. So the liquidity factor, because they are not easily traded, so 10 to 15%, they actually apply into that valuation. And the second point is no premiums or future share price analysis, because yes, in public company valuation, analysts can use premium paid analysis. How much above the market price acquirers typically pay in takeovers, and future share prices analysis also. But in case of private companies, this case there is no share price, so these analysis doesn't apply here. Uh, the the third point here is focus on enterprise value, not per share price, because public companies valuation often end with an implied share price. But for private companies, shares are not traded, so you focus on majorly on the enterprise value, which represent the value of the entire business. Uh, and the fourth point here, the challenge in DCF, because no market cap or beta is reported, we are not able to calculate the market cap or beta. So DCF requires a discounted rate, which was weighted average cost of capital, which requires cost of equity, market capitalization, and private companies do not have either of these. So the solution here to use DCF would be to estimate a weighted average cost of capital, looking at the comparable public companies in the same the peer and peer groups. So, in summary, if you talk about this, the valuing a private company is conceptually similar to valuing a public company, but with these main differences that where you adjust for liquidity, you cannot rely on the market-based metrics like beta, share prices, and market cap, and your valuation majorly focuses on the total business value and not on the share price. So, obtaining all this data is very difficult. So this is how you value a private company, and also the data. To find the data is also very difficult for a private company unless until they disclose them. And for there are different contracts. The contract of non-disclosure agreements also. So if you are about to acquire a company, so they will only give you limited information, and they will ask you to sign a NDA, non-disclosure agreement, to not publicize their financials in the public, because they do, in public private companies do not have an obligation to report out their financials to anyone. Their investors, they can, but not to the general public. So valuing a private company is very difficult, but yes, it could be done. All right, let's move to question number 33. So question number 33 is uh, the question is, why might we discount public company comparable multiples when valuing a private company, but not discount precedent transaction multiples? So we are talking about two valuation methodologies here: public company comparables and precedent transaction analysis. Precedent transaction analysis is done in merger and acquisition, and public company analysis is looking at public companies in the same industry and using their valuation multiples like EV, EBITDA, price to earnings to value the private company. And the precedent transaction looks at the past merger and acquisition deals of the similar companies and uses the multiple paids in those transactions. So the key difference here is the liquidity and control. If you think about it, so the liquidity difference here is because in public companies the shares are liquid, and in private companies the shares are illiquid. Liquidity means you can buy those shares anytime in the stock market, and illiquidity means you cannot sell them easily. And there is because there is no active market. And because of this illiquidity, investors demand a liquidity discount, which when valuing private companies, because being unable to sell shares freely is a real disadvantage, if you think about it. So when using a public company multiple, you often apply a discount to reflect the lower liquidity of the private company. And in precedent transactions, you are looking at the actual acquisition deals where a buyer purchases the entire company. Okay, so once acquired, if a company is once acquired, the buyer owns the whole company and liquidity doesn't matter anymore because they control the business. In the precedent transaction analysis, once the business has been sold and the buyer actually owns the whole company, so liquidity doesn't matter. So no liquidity discount is applied. The multiples already reflect what someone paid for 100% control. And here the intuition is that if you think of this, the public comps, that you are comparing your company to a your private company to a public company, you can buy or sell anytime. Since you cannot do that with private company, you value it slightly lower. And for precedent transactions, if you look, if you're looking for someone who just paid a specific amount to buy the whole business. So they do not need to worry about the liquidity because they already control the whole business. And the discount is about liquidity of shares, not control. And public company shares are liquid. Uh, Liquid and private shares are not liquid. And precedent transactions always assume full control. So liquidity is irrelevant in the precedent transactions. So that's the main reason. We discount public company comparable multiples, but not precedent transaction multiples because the discount rate is majorly about the liquidity. And in precedent transaction multiples, the, the, the valuation is more involved towards control and synergies. This was a pretty good question. I hope you guys have a clear understanding of public company comparables and precedent transaction multiples as by now. So let's move to the last question of the reading, question number 34, and let's analyze what the question is. So the question is asking, can you use private companies as a part of your valuation? And the answer is only in the context of the precedent transactions. It would make sense to include them for public company comparables as part of the cost of equity or working weighted average cost of capital calculation in a DCF because they are not public and therefore have no values for market cap or beta. Um, and and let's talk about it step by step. So valuation method. If we talk about the valuation methods, so there were three methods: public company, Compare comparables, precedent transaction, and discounted cash flow. Uh, why private companies cannot be used for certain methods is public company comparables. If you think about public company comparables, so company comparables rely on publicly available market data like stock price, market capitalization, and betas. And private companies do not have public stock data. So because they are not listed and you cannot compute their market cap or beta, which are critical for calculation cost of capital, cost of equity. So private companies cannot use the public company comps or DCF inputs directly. So think about it. And they cannot use DCF because DCF requires weighted average cost of capital, is which can be only driven by using the cost of equity using beta. Because the weighted average cost of capital is the weighted average cost of equity and cost of debt. And to calculate the cost of equity, you need require beta. And beta is market risk measure from public markets. So you cannot calculate beta here. So WACC you can eliminate with DCF here. So because weighted average cost of capital is the foundation element of DCF, so you have to eliminate the possibility of using DCF here. So precedent transaction analysis can be used in private companies because this method looks at the prices paid for the companies in the past deals. So precedent transaction analysis is used in merger and acquisitions. So private companies transactions are valid here because the valuation is based on actual purchase price, not on the market trading metrics. So the bottom line here is that the private companies are only useful in valuations when looking at the actual transaction price, not on the market multiples or DCF calculations. So think about it only in the context of precedent transactions. It would make no sense to include them for the public company comparables or as a part of cost of equity and weighted average cost of capital in a DCF because they are not public companies and therefore have no value for the market cap or beta. So let's wrap it up, and in the next reading, in the next lecture, we will start with with the advanced questions of valuations. Thank you, and all the best reading. And for any doubt, you can always post in the comments, and I will be happy to answer. Thank you, everyone.